But we're going to be doing a course here talking about Growth Investing 101, some of the basics. I believe we have 15 different videos outlined. And in this video being the very first one, all I want to talk about is what are growth stocks, what are growth investments. These are going to be some of the basic characteristics of growth investments. And first of all, number one, the reason why we call these growth stocks is because these are growing companies. So I know we've talked about this in the past, but companies can basically be in two different types of operations or modes, you could say. They could be in income mode or they may be in growth mode. And if a company is in income mode, they simply are paying out dividends. They don't have any stellar growth potential. And as a result, they're paying out dividends to shareholders to keep them around, to reward investors. And if a company is in growth mode, they're not focused on paying out dividends to shareholders. They're focused on growing that company, growing earnings and growing revenue. But once a company becomes a certain size, they're a very large company, they're a well-established company, the blue chip company, if you will, there's not a lot of growth potential for them, and they're certainly not going to be growing as fast as a newly formed company. So when you're looking at income investments, and we're going to cover more about this in part 2 here, so if this seems kind of brief, we're going to cover more of this in the second video. But if you're looking at income investments, you have to understand that these are larger companies that have already had a lot of that growth take place. But we're going to be focusing on the companies that are rapidly growing right now in this outline here or in this section when you're looking at growth investments. But the first characteristic of a growth investment is that the earnings of this company are expected to grow at a faster rate than the overall market average. So if company earnings overall were growing at a rate of 5% per year, a growth investment would have earnings that were growing at a faster rate. Maybe their earnings are growing at 10% per year or 15 or 20% per year. So that is what a growth investment is. Now you might be comparing this to the actual industry or sector average. So if you were looking at a semiconductor company, you would look at the earnings growth of this company over the next 5 years, the projected annual growth rate, and you would compare that to the projected annual growth rate of that industry or maybe of the competitors. So all you're looking to do, if you're looking to identify a growth stock, one of the first things you're going to look at is that growth rate of how fast this company is expected to grow earnings over the next 5 years or so. And you're going to see if this company is going to be growing faster than that industry or sector average and also faster than the peers. Now, the second thing you're going to notice about growth investments is that it's typically newly formed companies. These are not companies that have been around for hundreds of years. Now, sometimes you do see an older blue chip company performing like a growth stock. We're seeing that happen with Boeing as far as what happened in 2017, how that share price went up almost 100% in 2017. We covered that over there in the stock analysis section of this group if you guys missed that. But sometimes you will see a large, well-established old company performing like a growth stock because they're turning over a new leaf or the business has significantly improved. So, but typically speaking, these are going to be newly formed companies that are going to be growth stocks. We're talking about companies like Facebook, like Amazon, like some would even say Apple is a growth stock. They're more of a conservative growth stock. Now we're going to be talking about both conservative and aggressive growth stocks in this course here because most people know that growth stocks are higher risk and higher potential return investments, but there are lower risk investments in the growth stock area, which would be the conservative growth stocks or companies like Apple, for example. But you want to think about growing companies that are in a growing industry that are rapidly evolving. That is typically what we're characterizing growth stocks as. So what else do we know about them? They are typically operating in a new or emerging industry. And the example that I want to use here is the marijuana industry. So there's no blue chip companies right now that are growing medical marijuana because this is a brand new industry. So all of these companies that are out there that are growing marijuana for medical purposes in Canada and they're publicly traded, all of these are very small cap growth stocks because they're brand new companies. Maybe in 50 or 60 years, if this industry continues to take off the way it does, and some of these companies become these well-established companies, now they're not a growth stock anymore, they're an income stock. But because the marijuana industry is so new, there are no big players there because there hasn't been a chance for anyone to really take off and become the big player as far as the blue chip company there. These are all newly formed smaller companies. So typically, you're going to find that all of the companies that are operating in a new or emerging industry are typically going to be growth stocks. Number 4, you're going to find that these stocks are going to have higher volatility. And if you're not familiar with what volatility is, we do talk about this over in the course on stock tables. But basically, volatility is the tendency for this stock to have upward and downward price movements. The best way to look at the volatility of an investment is to look at the beta. That compares the volatility of this stock to the overall market. But you're going to find that growth investments are typically going to be more volatile. There's going to be more people buying and selling them. And you're going to find there's more explosive price moves with growth investments just because these are not well-established companies with a track record. These are newly formed companies, and most of them don't have a track record, and a lot of them also are not even profitable companies. So they're going to be inherently more volatile. And this is something we don't have on the list here, but we also know that growth stocks are typically going to be smaller cap companies. Not always the case, because we know Amazon and Facebook are growth companies. They're growth stocks, but their market caps are through the roof. They're mega cap companies. But typically speaking, you're going to find that growth stocks are going to be smaller cap companies. And as far as market capitalization goes, if you're not familiar with that, that's just the price per share times the outstanding shares, or what the actual market is valuing this company at. And typically, if it's a growing company in a new industry, it's going to be smaller, and it's going to be a company that has less value, or it's valued at a lower price by the market because it is a new company. Now, another thing you will find when looking at growth stocks is that they typically are higher PE ratio companies due to the fact that a certain amount of that future growth potential is priced into today's number. Now, if you want to learn more about how to value a company, go ahead and take Fundamental Stock Analysis 101, and we're going to talk about the PE ratio, the forward PE, the PEG ratio, all kinds of different ratios to determine how much of that future growth or anticipated growth is priced into today's number. So we're not going to go into that in any more detail because that's already been covered in Fundamental Stock Analysis 101. But these companies are typically going to have a much higher PE ratio than an income investment out there would. Number 6, you're going to find oftentimes these companies are not even turning a profit. This is largely due to the fact that they're oftentimes operating in a brand new or emerging industry, and they're laying out a lot of capital to grow the company as fast as possible. So if we use some of these marijuana stocks or marijuana companies in Canada, a lot of these companies are expanding their operations, they're upgrading and building new facilities, and they're throwing as much cash into the business as possible to grow as fast as possible. And as a result, many of those companies are not profitable, and this is something that is typical of a growth investment. However, it is not always the case. And I will say this, if you are a beginner, and you're looking to get some exposure to some growth investments, but you're not looking for any kind of crazy volatility, avoid any company that is not turning a profit. It is these unprofitable companies that are typically going to be a lot more volatile. And then the final characteristic I have of a growth stock is that you should expect a 20% or more drop at some point in time. I'm not saying it's going to happen tomorrow. I'm not going to say it's going to happen at all, but just be prepared for it emotionally, because this happened to me with my investment in Advanced Micro Devices. It's one of the stocks I've been holding for a very long time. And at one point in 2017, they reported earnings that disappointed investors. And because at that point in time, they were an unprofitable company, the stock just fell flat. The stock fell like 25% over the course of one trading week. And you just have to keep that in the back of your mind, that this is something that can happen with a growth investment, because these are higher risk, higher potential reward investments, and you have to have the stomach for that. If a 20% loss is something that scares you and you don't have the stomach for it, then you should probably stay away from high risk growth investments or aggressive growth stocks, especially those that are companies that are unprofitable. That's just not going to be the right investment for you. And in this video, we're going to be talking about growth investing versus income investing, and what each of these actually looks like using numbers as examples. It's one thing to explain it with words and say, okay, so a growth investor is looking for asset appreciation, while an income investor is looking for those regular dividends, but it's easier to actually visualize it, in my opinion. And so what I'm going to show you in this video is what it looks like to be a growth investor, what it looks like to be just purely an income investor, and then what it looks like to have a blended strategy of both of these, and then what the actual goal is of all of these things. So whenever you're investing, you always want to make sure you have a goal as far as what you are investing for and what each of these stocks or investments is doing for your portfolio. Is this a growth component of your portfolio, an income component? Is it a little bit of both? And so you kind of want to know before you buy something, what is this actually doing for me? So let's go ahead and start out by looking at a growth investment and showing what you're actually looking to have happen when you're buying a growth stock. So when you're investing in a growth stock, it's a company that is likely not profitable. Maybe it is profitable if it's a more conservative growth stock, a company that's been around for a long time. Or maybe it's a company in a brand new industry and they don't have a means of turning a profit right now. What are you actually looking for that company to do? Well, hopefully down the road, that company is going to become profitable. They're going to turn a profit. And what's going to happen is as that company is reporting earnings and growing earnings, you're going to see that share price increase as a result, or you're going to find that you have asset appreciation. So let's say you buy that stock for $1 a share, and then a year later, it's $1.10 per share, and then 2 years after that, it's $1.20 per share. So what you're seeing take place there is asset appreciation, where the actual value of those shares is increasing over time. So how do you make money when it comes to investing in a growth stock if they're not paying you dividends? You make money by buying at a lower price and then selling at a higher price. So the way you would make money in this situation would be buying your shares $1 per share, and then maybe 2 years later selling for $1.20, and then you made 20 cents per share on however many shares you had of that company. That is how you're going to make money as a growth investor. Now, as an income investor, what you're looking for is just those regular cash payments from that stock, those dividend payments. You really don't care about the asset appreciation if you're purely looking for income. Now, most investors out there are not purely looking for income from their investment. They want both. They want to make sure the actual underlying asset or the stock is appreciating in value, as we saw here, and they also want to get those regular cash payments from that investment. But if you're purely looking for income, all you're looking for is those dividends. So in year number 1, that stock is $1 per share. In year number 2, that stock is $1 per share. In year number 3, that stock is $1 per share, but each year you got 5 cents in dividends per share. So all you care about as a pure income investor is that 5 cents paid out to you per share per year, or that 5% dividend. Now I'm guessing that most people, including me, are not interested in being a pure income investor, because I also want to make sure the actual stock I'm investing in, the actual share price, is going to increase over time. So that's when you're looking for a blended approach of both a growth and an income investment. So the actual company has growth prospects to grow earnings and at that point have a higher share price as a result, but they're also a well-established large company that is able to pay out a quarterly dividend. So maybe you buy shares for $1 per share, and a year later the shares are $1.03, and then a year after that they're $1.06, but during that time as well, they paid that 5-cent dividend. They paid that 5-cent dividend. So in the blended strategy, you're able to be paid in two different ways. Number one, the asset appreciation, where that stock went from $1 a share to $1.06 over those 2 years. And then number two, you also have those regular dividends that company is paying, and hopefully they're raising those dividends as well. Now I know we're talking about growth investing in this course, and I just threw in there income investing, and I'm going to do a whole course on income investing 101. I'm sure you guys are going to be interested in that, but if you're not for some reason, just let me know. But seems like a logical step for me to do that very soon here, probably after I do this course. We'll do Income Investing 101. But now you understand what the actual goal is here when you're investing in a growth company or a growth stock. You're looking to have that asset appreciate. And maybe this is a company that is a blended investment, where it's a little bit of a growth investment, a little bit of an income investment, because it's a company that pays dividends, but they do have strong growth prospects. And so you're looking to get paid in two different ways. But what is the actual goal here with these strategies? If you're looking to invest for growth, what you're looking to do is build your wealth. So that is why a lot of young people are investing in growth stocks, and we're going to cover that later on as to who should be investing in growth stocks. But when you're investing in growth stocks or a growth investment, you're looking to build wealth, while most people invest in income investments with the goal of both preserving their wealth and outpacing inflation. So first of all, you're looking to invest in a company that is paying out those regular cash payments, and you also want to make sure you're investing in a company that's not very volatile. You don't want to see any explosive moves with that share price, because if you're older and you're investing for income and you're just looking to preserve your wealth, you don't want to see that actual underlying asset decrease a lot in value, because at that point you're going to be needing that money in the short term. And so that's why a lot of people actually nearing retirement age have very little money involved in stocks, because it's very hard to find a very stable investment when it comes to stocks. Maybe you'll find a very low risk index fund of some kind, but if you are looking to invest for income, the goal there is to preserve your wealth and to outpace inflation. And if you're going to do both, if you're looking for a blended investment, you're looking to have both that asset appreciation to give you that growth to build your wealth, but you're also looking to get the dividends in order to beat inflation and have that second option available to you as far as being paid. And most people who are investing with that blended approach are probably going to be setting up a DRIP or a dividend reinvestment plan. And so all of those quarterly dividend payments are going to be reinvested back into that issuing stock just to allow you to accumulate more shares that are hopefully going to appreciate in value and pay you more dividends down the road. And that is right there how you build a serious amount of wealth for yourself. One way right there is using compound interest and allowing your money to grow over a very long period of time. And in this video, we're going to be talking about the difference between being an aggressive growth investor and a conservative growth investor. And this goes hand in hand with investing in aggressive growth stocks and conservative growth stocks. So they should go without saying, but I'll go ahead and say it anyway. An aggressive growth investor will be investing in aggressive growth stocks, and a conservative growth investor will be investing in conservative growth stocks. And if you're somewhere in the middle, you might be looking to invest in blended companies that are somewhere in the middle there. They're not super conservative, but they're not super aggressive either. And so basically all I want to do here is outline the difference between these two and really how you can begin to determine whether or not a company is a conservative growth stock or an aggressive growth stock. So first of all, the easiest way to explain this is to start by defining both conservative and aggressive. So conservative simply means cautious about change. You're not interested in a lot of rapid change or sudden change, while aggressive means you are open to rapid change. So if you are a conservative investor, you're not looking to have any kind of crazy amount of change take place in a short period of time. But if you're an aggressive investor, you're open to massive amounts of change. So think about a company like Amazon. That is an aggressive growth stock. We're going to talk about that a little bit later on. But that's a company that is changing all of the time. They're acquiring new companies. They're releasing that they're getting involved in new industries, whether it's the healthcare industry or video gaming or pharmaceutical, whatever it is. They're constantly releasing announcements that they're getting involved in new industries, and they're rapidly changing all the time. Where if you look at a more conservative growth investment, and I'm going to lump Apple into that, they're not super conservative, but they're definitely a more conservative growth investment. It's pretty clear on where this company is heading in the future, and you're not going to really hear about Apple making any kind of crazy sudden changes overnight. They're pretty consistent at this point in time, and that's typically the difference between a conservative growth investment and an aggressive growth investment is the amount of change taking place over a period of time. You're going to find with an aggressive growth investment, there's massive amounts of change taking place all the time. With a conservative investment, it's pretty consistent what that company is doing as far as their operations go. So first of all, let's start with some of the characteristics of the conservative growth investments. First of all, you're looking for slow and steady growth over a long period of time. So if you're a conservative growth investor and you're looking for a conservative growth stock, you're looking for a 5+ year of consistent growth in operations, and maybe even longer if you're looking for a more stable and time-tested investment. You're looking for low volatility. You're not looking for any kind of crazy volatility where that price is going up and down all the time. You're probably looking at a company that is profitable. You're not going to find a lot of unprofitable companies that fall under the category of being a conservative growth stock. And you're looking to buy a company at a reasonable valuation. So maybe you're somebody who is a growth investor, and then you use the fundamental analysis to determine whether or not that company is overvalued, undervalued, or fairly valued. And you're basically looking to buy a company that's reasonably valued by the market, that doesn't have a lot of crazy volatility, but they're going to have consistent growth over a long period of time. That would be a conservative growth investment. And a few examples of this are Johnson & Johnson, Procter & Gamble, and Cisco. And a lot of these companies pay dividends as well, so they're actually kind of a blended strategy of both growth and income. That is what a conservative growth investment would be. Now, on the other hand, an aggressive growth investment is going to have high growth potential. There's going to be a lot of change taking place with that company, and there's going to be a lot of movement with that share price, and as a result, there's going to be high volatility. Now, that high volatility might sound exciting, but it's definitely not for everyone, and so a lot of people are not interested in investing in aggressive growth stocks. Now, as far as the valuation goes, when you're looking at aggressive growth stocks, the actual valuation of these shares is of little to no importance of these investors, because all they care about is the future prospects for this company. They care about the future and what this company will be doing a few years down the road. So they say, I know this is a sky-high PE ratio, or the forward PE is astronomical for example, looking at a company like Amazon, but they're just so dominant that I'm willing to pay that price because I strongly believe in this company's future. So they say that I know the PE ratio is very high right now and the forward PE is very high, and that's the case with a company like Amazon, but they believe that company will be doing so well in the years going forward that they don't care about the actual valuation of those shares and they're willing to pay that price. So a few examples of aggressive growth stocks would be Amazon, Tesla, and Nvidia. These are companies that are rapidly changing. They have huge growth potential, but they are very expensive stocks if you look at the valuation. But do remember that aggressive growth investors really don't care too much about the valuation of those shares. Now do keep in mind, like I said, you can find stocks in the middle, you can find stocks that are more conservative, and you can find stocks that are more aggressive. And maybe stocks like Johnson & Johnson and Procter & Gamble are putting you to sleep. Well, there's probably something in the middle here between Johnson & Johnson and a stock like Tesla, where you can find a company that is a little bit more aggressive, but they're not super aggressive to the point where that valuation is just nonsensical. And a lot of the times that happens with these aggressive growth investments. And in this video, we're going to be talking about what the actual goal here when it comes to investing in growth companies is, or what you're looking to have happen in order to have that asset appreciate. So as we know now, a growth investor is looking to buy a stock at a certain price and then sell it at a higher price down the road. But what is actually going to happen or take place that is going to cause that actual share price to appreciate? Well, that's what we're going to outline in this video. And there's very simple steps here. 5 simple steps have to take place in order for that asset to appreciate. So first of all, we're assuming we're investing in a company that is in a growing industry or sector because we've already said a growth stock has earnings that are expected to grow at a faster rate than the overall market. So we know that the sector or industry must be in favor in order for that company to be experiencing higher than average growth compared to the overall market. So number one, the industry growth will result in more sales for that company. So they're selling more of the goods and services they provide. So number two, we're looking to see that the sales growth is resulting in revenue growth and then eventually resulting in more gross profit for this company. And if the cost of revenue is out of control, then this may not be the case. You might see a company with more sales and more revenue, but because cost of revenue is growing even faster, their actual gross profit is flat or not seeing as much growth. So that's when you want to be looking at the fundamentals and determining whether or not the actual increase in revenue is resulting in more gross profit for that company. Now, number three, we are hoping that revenue growth is going to be resulting in more earnings growth. And again, this isn't always the case. So are we actually seeing growth in the bottom line as well as the top line, or is this all top line growth for this company? Or are they actually having growth on the earnings per share this company is delivering? And if that's the case, we're hoping that higher earnings per share will attract new investors and make this a more appealing investment. And as a result, you're going to have investors stepping up to the plate, buying shares, increasing the demand for that stock, and driving up that share price. So number 5, the 5th step, if all of these things are working together and everything is going well for this company, then the share price will appreciate. But why does this actually happen? I'm going to give you a very simple example here looking at the PE ratio of a company. So let's say the company is $100 per share and the annual earnings is $2 per share. That means their price to earnings ratio is a 50. And let's say for this industry, that is a very normal PE ratio. Let's say it's the semiconductor industry and a PE of 50 is actually normal for this industry. Now let's say that company is doing very well and their earnings have now doubled. So now their earnings per share over the last year are $4 per share. But let's say it's still valued at just $100 per share. Well, now that company has a PE ratio of 25. So if you're an investor and you're looking at the semiconductor industry and you're going through potential investments and looking at the PE ratio and you see a 51, a 52, a 48, a 47, and then a 25, you're going to go, wait a second, that is significantly undervalued. I'm going to buy shares of that company. Now, I am not saying you are going to have the opportunity to do that because the market is very efficient and you're not going to find a PE of 25 out of nowhere. So you're not going to be able to unearth opportunities like that in most cases where you're going to have a PE of 25 when the industry average is a 50, but you might find a slightly lower PE due to the fact that the earnings are higher and it is actually deflating that price to earnings ratio as a result of having higher earnings. So we know that that stock should now be priced at the industry average PE of 50. So in order for that to happen, the share price will have to increase. So in order to have a PE of 50 on $4 of earnings per share, you need to have a stock that's worth $200 per share in order to have that PE of 50. So if the company earnings per share doubled and everything else was the same, then you would need to have that share price double in order to have that same price to earnings ratio as you did before. And in a nutshell, that is the goal here, and that is what happens when you invest in a growth stock and you see asset appreciation taking place. And in this video, we're going to be answering a very simple question, which is, who are they for? Who should be investing in growth stocks or growth investments? And primarily, it is three types of people, and we're going to outline those right here. So hopefully this will give you a good idea of whether or not you should be investing in any growth stocks or any growth funds, index funds, something like that. But first of all, it's for people that have enough time on their hands in order to let stocks trend upward. So particularly, we're talking about young people. So people like myself, if you're young, if you're in your 20s, or maybe you're even a teenager still and you're starting early, then you should be investing in something with some growth because you have enough time on your hands to allow that stock or that fund to trend upward. And you can afford to be a little bit more aggressive with your portfolio than somebody who is nearing the age of retirement. So a young person is going to have a much more aggressive portfolio than an older person does. And so if you are a young person and you have a lot of time on your hands, then you should consider investing in some growth stocks or possibly a growth fund if you don't want to be involved in individual stock ownership. Now, number two, the second type of person who should be involved in growth stocks is somebody who has enough money. They have enough money to take on higher risk because if they're wrong about an investment, then it's not going to be detrimental to them. So you're definitely not going to be turning around and investing your life savings into growth stocks because these are higher risk investments. But if you're somebody who has a lot of money, you're already well diversified, and you want to take on some aggressive growth investments just to see how it pans out, then that would be a good fit for you because you have other investments, you have other pools of money, to where if you lost this one or you took a significant loss on that, it wouldn't be detrimental. Now, if you were somebody who didn't have a lot of money and you were older, then you probably shouldn't be investing in growth stocks because, number one, you don't have time to let those stocks trend upward if you make a bad decision. And number two, you don't have a lot of money to offset a potential loss that could occur with a growth investment. Like we said, these are higher risk and higher potential return investments. And as a result, if you are an older person, it really doesn't make sense to take on high risk at this point in your life. And then third of all, this is people who have enough experience to not get emotional or emotionally involved with their investments. So if you know you're the type of person who gets emotional when it comes to making money or losing money, then you should probably stay away from growth stocks until you have some more experience with the market. Start out with blue chip stocks, start out with dividend stocks. These are much lower volatility investments. There's going to be a lot less risk, less potential return, but also less risk there. And you need to do that in order to get some experience with the market and really develop a gut for the market. Because if you haven't done that yet, and like we said, if you see a 20% drop in a growth investment you're involved with, are you going to get emotional about that? If all of a sudden you're down 20% on an investment, are you going to have the desire to sell and cut your losses? Or what will your decision be at that point in time? And in this video, we're going to be covering three telltale signs that you are in fact looking at a growth stock. Now, later on in this course, I'm going to be showing you guys one of my favorite tools to identify a breakout industry or sector, because one of the very first things you want to look for is to make sure that this company is in an industry or sector that is growing faster than the market average. And I'm going to be showing you guys my favorite tool to use in order to find the breakout industries and sectors out there. But when you're looking at an actual stock, how can you tell whether or not this is a growth stock? These are three telltale signs in my opinion. And number one is that the projected 5-year annual growth rate exceeds the past 5 years. And this is very simple. Is the company going to grow faster in the next 5 years than it did in the past 5 years? Now, do keep in mind the projected annual growth rate is set by analysts. It's analyst expectations, and at the end of the day, it's their best guess, but really it's the only number you can go off of because nobody knows what's going to happen with that company in the future. But hopefully the analysts have a pretty good idea when you take the average figures across all of them as far as what their expectations are for this company. Now, as far as finding this information, I like to use Yahoo Finance. And if you guys want some more information on navigating that page, check out my free course on Stock Tables 101 that's also a part of this group, where I show you all of the information available on Yahoo Finance. That is the tool that I like to use for this type of analysis. But if you go to the Yahoo Finance Analysts page, it will give you the anticipated 5-year growth rate as well as the historical 5-year growth rate. And for example's sake here, we're going to use Qualcomm. So Qualcomm over the past 5 years had a growth rate or an annual growth rate of negative 3.24%, but the anticipated growth rate over the next 5 years is 15%. That's a very good growth rate. And what we like about this is, first of all, it's a double-digit annual growth rate, which is something that you should look for in a growth investment as far as an aggressive one. If it's a conservative growth investment, then you might not want a double-digit annual growth rate. But what you want to see here is a double-digit annual growth rate for an aggressive growth investment, as well as the fact that the anticipated 5-year growth rate is a lot higher than the past 5 years. It's going to be growing faster in the next 5 years than it did in the previous 5 years. The second thing we like to look for is that earnings per share are growing and also beating analyst expectations. So again, I use the NASDAQ page. They have a really good page layout as far as the earnings surprise go. It tells you whether or not that company is beating expectations, in line, or below expectations. But there's a lot of different tools out there that you can use, but I like the one that NASDAQ offers. It has the earnings surprise. But so let's use NVIDIA, for example. These are the annual figures, but for fiscal year 2016, they did $1.08 in earnings per share. For fiscal year 2017, they did $2.57 earnings per share. And for fiscal year 2018, they did $4.82 earnings per share. Now, I didn't go ahead and calculate those percentages, but it's clearly more than a double-digit growth per year in earnings per share, and that makes this a very aggressive growth stock. And on top of that, over the last 4 quarters, NVIDIA has beat analyst expectations in all 4 of those quarters. So they are growing earnings per share at a very rapid rate, and they are beating analyst expectations, another sign that this here is a growth stock. And then third and finally, we look for double-digit revenue growth year over year. And for this, we're going to use Planet Fitness as an example. So in fiscal year 2015, they did $331 billion in revenue. For fiscal year 2016, they did $378 billion. And for fiscal year 2017, they did $430 billion. So that gives them an annual growth rate of 14% per year, making this a growth stock. So that right there are the 3 signs in my mind that you're looking at a growth stock. This is what I'm looking for. And ideally, a company you're looking at is going to meet all 3 of these criteria, but it's not always going to be the case. But these are 3 definite signs that you are looking at a growth stock. And in this video, we're going to be answering a simple question, which is, how long should you expect to hold a growth stock? So let's say you go through, you find a growth investment you like, you invest in a particular stock, and now you're asking the question of, how long should I wait until I sell this stock? So you know the basics of what you're trying to do. You're trying to buy the stock at a lower price and sell it at a higher price down the road, because we know the stock isn't going to be paying you dividends. So the only way for you to make money with this stock is through asset appreciation or by buying low and selling higher. But when would you actually decide to sell a stock? I'm going to go through these 5 right now. Now, first of all, the one that I'm not even including on the list is one of my rules of thumb, which is anytime I have a 20+% return in the short term, I'm talking about in a month or even in a week, it's happened before. If you have a quick 20% return, something like that, I'm selling. I'm going to take that profit off the table, and I'm going to consider that a good day for me or a lucky day for me. Anytime you're going to see an explosive price move like that, whether it's from a company beating expectations with earnings, or maybe they're being bought out by another company, anytime you have a 20+% gain in the short term, you better bet that I'm going to be selling and taking that profit. But other than that, how long should you be holding a growth stock? These are my 5 rules of thumb. So number 1 is until the stock becomes overvalued, and I'm going to use Netflix for an example. So let's say you invested in Netflix stock back in 2017. You thought it was an interesting growth investment, and then in 2018, we know that stock has just gone absolutely crazy as far as that share price, and maybe in your mind you said, you know what, it seems like this stock is heading into uncharted territories. The PE and the forward PE are sky high. I don't think this stock is a good value anymore. I'm going to sell to the optimists. That's what the STTO is there. So if you're investing in a growth stock, you have money on the table, you've made a good amount of money there, or you have a good return, and you feel that that stock is beginning to become overvalued, it's getting hyped by the market, the herd is entering that investment, that is a good time to sell to the optimists and take your money off the table. Number 2 is until the trend loses momentum. So if you're investing in a stock and you find that the trend is running out of momentum, or it's like it's running out of gas and you can tell that it's having trouble making it to a new price level, maybe you're using technical stock analysis and you see that it's falling to a 20 or a 50-day simple moving average, and you're saying, you know what, I think this trend is out of momentum. that again is a sign that you might want to sell that stock. Number 3 is when your money is better used somewhere else. And let me just say, this is not if you're losing money. So if you invested in a growth stock and then you're down 10, 15% and you're impatient and you say, you know what, I'm going to sell this stock and buy something else, that is not the right move 99% of the time. What I'm talking about is if you have money on the table, you've made a return on that investment, but you know that there's more money to be made somewhere else and your money is better off being put somewhere else, that is a time when you might decide to sell. So let's say you're investing in a particular stock in a growing industry, but you find out or you realize there's going to be a better industry to be investing in and you want to take your money out of this and put it somewhere else. That is an acceptable time to sell a growth investment. But again, I'm just going to repeat myself. Do not sell and lose money because you want to be putting your money somewhere else due to impatience. If you're investing in a growth stock, you've already agreed that you're going to allow these stocks to trend upward if you're wrong about this investment, and it might be something you have to do. So don't be surprised if you're stuck holding on to a stock for longer than expected when investing in growth stocks. Number 4 is when you have long-term capital gains. A lot of people don't think about the taxes associated with an investment, but I'm sure it makes sense to you to be paying the lowest amount in taxes possible, and that is by waiting until you have long-term capital gains on your investment. So in a nutshell, if you hold a stock for less than 365 days or equal to 365 days, you're going to pay the highest rate possible on your capital gains. They're short-term capital gains. But if you hold it for longer than 1 year, they are now long-term capital gains, and it's going to be a lower tax rate. And depending on what bracket you fall into, it could be as much as a 20% difference. So you definitely want to make sure that you're recognizing long-term capital gains if possible. And again, this is US specific advice, so if you're listening to this from a country outside of the US, then you have your own tax situation, and I'm not really sure what that would be for you. But if you're from the US, then you want to make sure you have long-term capital gains, as it is a much lower tax rate. And then 5th and finally, as far as how long you're going to be holding that growth stock, it's typically 3 months to 3 years. Maybe you're holding a stock through the earnings report, you think they're going to do well for earnings, and after they report stellar earnings, you're going to sell. Or maybe you're trying to ride out a longer trend over the course of a couple of years, but typically speaking, it's going to be about 3 months to 3 years that you're expecting to hold on to a growth stock. And in this video, we're going to answer a question, or it's like a heated debate that I see time and time again of, what is the best type of investment to get into? Should you invest in value investments of large companies, blue chip investments? Should you invest in large cap, mega cap growth investments or small cap growth investments? And what I'm trying to show you in this is that everyone is right and nobody is right at the same time. At the end of the day, as I'm sure you can imagine, the best strategy to have looking at numbers like this is to own a little bit of everything. Have a little bit of value side to your portfolio with some large cap blue chip stocks, and then maybe have some mega cap growth stocks in there. You're talking stocks like Facebook, stocks like Google, Amazon, and also have some small cap growth in there as well. So time and time again, what you're going to find looking at the numbers is that diversification is going to win out. By owning a little bit of everything, you're going to have the best possible return, because sometimes mega cap growth stocks are going to be better. Sometimes value investments are going to do better, those blue chip stocks, the dividend stocks, and sometimes small cap growth stocks are going to be the winner. And that's what I plan to show you here looking at these numbers here. And this should help you determine whether or not you should be investing in growth or value. And my hope is that after seeing this, you decide to invest in both. But what we're looking at here is the performance of the Dow Jones Industrial Average, as well as 2 Vanguard index funds. One is VBK, which is a small cap growth index fund, and then the other is MGC, which is a mega cap growth index fund. So we're looking at mega cap stocks, which are very large companies, high or large market capitalizations. That's like stocks like Amazon, stocks like Google, the big companies, Facebook, stocks like that, the mega cap growth stocks. And then small cap growth is going to be all of these smaller companies that are growth stocks. Maybe we're talking about a stock like Planet Fitness or a stock like Fitbit, something like that. We're talking about smaller companies. So just so you understand the difference between these, and we've already talked briefly about the Dow Jones Industrial Average, but those are 30 large, well-established, financially stable companies that have been around in most cases for decades, if not centuries. So let's go ahead and look at the performance of these funds and also the Dow Jones Industrial Average to try to determine what the best strategy is. So over the last year, we saw an 18.8% return with the Dow Jones Industrial Average. Over the last 5 years, we saw a 70.6% return with the Dow Jones Industrial Average. And over the last 10 years, we've seen a 92.7% return with the Dow Jones Industrial Average. Now, looking at small cap growth stocks, looking at the VBK fund, over the last year, we've seen a 22.7% return from that fund. Over the last 5 years, a 70.2%, and over the last 10 years, a 179% return from that fund. And then we look at the Mega Cap Growth Fund, MGC. Over the last year, it has returned 16.9%. Over the last 5 years, 77.4%, and over the last 10 years, 109%. So what you should be gathering by looking at numbers like this is that it's not the same in the same time frame. You're not going to see the Dow Jones Industrial Average performing better than these all the time. You're not going to see small cap performing better than mega cap all the time. It's going to be different depending on what time frame you're looking at. So over the last year, small cap growth was the best performer. The Dow Jones Industrial Average came in second place, and the Mega Cap Growth Fund came in third place. But over the last 5 years, the Mega Cap Growth was in first place. It went from last place over the last year to first place over the last 5 years. So then you have Mega Cap Growth being first, the Dow Jones Industrial Average being second, and Small Cap Growth being third. So it completely reversed itself over the last 1 year versus the last 5 years, and that right there should be enough to show you should have all of these things. You should have some large cap growth, some small cap growth, and also some good value investments. So this is all I'm trying to show you guys here, is that a blended approach of all of these things is going to be the best strategy. And then over the last 10 years, small cap growth has been the clear winner. Mega cap growth was in second, and the Dow Jones Industrial Average was in third. So the takeaway from this is that when you hear people arguing about their investing strategy being better, that they say, oh, I only invest in small cap growth, or I only invest in the Dow Jones Industrial Average companies, or I only invest in mega cap growth, you can just take a step back and laugh at them and understand that a blended strategy of all of these things is going to be the best thing for you. But you're going to find a lot of people have their opinions about what you should be investing in. And as always, guys, the best thing to do is to be diversified. And in this video, I'm going to be introducing you to a man by the name of the value-oriented growth investor. And I really want to just introduce you to this concept because I have a feeling this is something that will interest you. When I first stumbled upon this concept or this idea, and really it's very simple, but this idea that you can use fundamental stock analysis to analyze growth stocks, it was like one of those light bulb goes off in my head moments where I was like, I can combine both of these strategies and become a value-oriented growth investor. So what does it mean to be a value-oriented growth investor? Well, I pretty much have a couple of different things here I want to cover, or 4 main points. So as a value-oriented growth investor, you understand fundamental stock analysis. And if you guys haven't taken Fundamental Stock Analysis 101, I would highly recommend doing that to get some of the basics under your belt. But as a value-oriented growth investor, you understand you can use the principles you learned through fundamental stock analysis when looking at both growth stocks and income stocks. So just like we talked about looking at things like the dividend coverage ratio and studying the company fundamentals and whatnot, you can use all of this while also looking at growth stocks. Now, yeah, growth stocks are not going to be typically paying a dividend, but you can look at things like the PE ratio, the forward PE ratio, the PEG ratio, and really understand whether or not the valuation makes sense today and if it's a valuation you are comfortable with. So many people go out there and just buy into the hot growth stocks because, let's be honest, these are the most exciting companies out there. They're doing the most. They have the most innovative products or services, and they're really exciting to get behind. Everyone was super excited to say, I'm buying into Tesla. I own shares of Tesla stock. It was very sexy to say, I own Tesla, rather than saying, I own shares of 3M. It's boring. But you have to understand that with a stock like Tesla, you have to understand a lot of that future growth is priced into today's number. And when you start to see snags with what's going on with them, because at the end of the day, no company can execute with perfection forever, that's when you start to see that share price fall. So you have to take a step back when looking at a growth stock and say, even though I'm super excited about this company, does the valuation make sense? And at that point, you have become a value-oriented growth investor. Now, the other thing you understand is that growth stocks can become overvalued. They're very prone to becoming overvalued because it's easy to get excited today about what's going to happen tomorrow. You hear about companies getting involved in artificial intelligence or autonomous driving or who knows what, but all of this future technology, it's very exciting. but that doesn't mean it's going to turn into a reality, or it may not happen as quickly as they believe it is going to happen. And all of that is going to cause that share price to fall if all of that future growth is priced into today's number. At that point, a stock becomes priced for perfection, and you're not going to see many companies out there executing with perfection. Maybe they're going to execute with perfection for a period of time, but at a certain point they're going to hit a bump in the road and it's going to cause that share price to fall. The other thing you understand is just basically you look at the numbers and you say, is this something that I am comfortable with? Are you comfortable investing in a company with a PE of over 100, or a forward PE of over 50, or a PEG above 3? Whatever your criteria is, you have to set that criteria for yourself and say, I'm not going to go beyond this. I'm not comfortable with a stock with a triple-digit PE ratio, or a forward PE ratio of 50 or 40. Whatever your number is, you have to figure out what your comfort zone is, and at what point you have to say, look, this just doesn't make sense. Yeah, I'm excited about this company. Yeah, I'm excited about where they're heading, but I just cannot get behind the company at this current valuation. And at that point in time, maybe you make the decision to invest in something else, or you're just going to wait for the right time to buy that. Just because you're not buying this stock today doesn't mean you can't buy it tomorrow, or 3 months from now, or 6 months from now. And if you find a stock that's priced for perfection, it's a good idea to wait for that stock to go into a correction before you add shares to your portfolio. And the other thing you understand, fourth and finally, is that you do not buy a growth stock when all of the anticipated growth is priced into today's number. And how do you determine this? By conducting fundamental stock analysis, looking at the numbers and saying, am I comfortable with this valuation? So you know that it's not wise to buy stocks that are priced for perfection. You don't want to buy the stocks that everyone's buying into. At that point, you're following that herd mentality. And you don't want to be doing what the herd does. You want to be doing pretty much usually the opposite of what everyone else out there is doing. So if you hear about everyone and their brother getting into a particular stock or asset, that might be a time when you say, I think I should probably get out of that or stay away from that. You kind of want to unearth the gems that people are overlooking. And if everyone is super excited about tech stocks and semiconductor stocks, maybe it's a time for you to avoid that sector entirely. But that's pretty much the idea here that I want you guys to think about. Maybe you do decide that you just want to invest in the stocks that everyone loves, and you just want to invest in the FANG stocks. That's what's hot right now, or the semiconductor stocks. Those are what did really well, in 2017. But you just have to keep in mind that these stocks are going to become more and more overvalued with time as the herd moves into that asset. And you just have to be aware of that and set limits in your mind of where you would sell if things were to go south, or what kind of gain you're looking to get from that investment. But I hope that a lot of you guys understand the appeal of being a value-oriented growth investor, and you understand the idea behind not buying into growth stocks that are overvalued or overhyped. And in my opinion, this is going to be one of the most important videos of this entire course. So I hope you guys pay attention, take some notes, or revisit this once in a while when you're looking to find a growth investing opportunity. So this is a very reasonable question. Yeah, we've talked about some of the basics here about what growth stocks are, what to look for, being a value-oriented growth investor. But how do you actually find a growth stock? How do you find a company growing faster than the overall market? That's what we're going to talk about in this video, is how do you find these opportunities? Now, in my opinion, it primarily comes from 3 different avenues. You have to look at the political environment, the economic environment, and then the social environment. And looking at all 3 of these things, you can determine what industries or sectors are going to be experiencing more or less growth. So let's go ahead and talk about this more, and we're going to use some examples as we go through this. But first of all, political is party-based. In the United States, it's based on what president has been elected. So we know right now Donald Trump has been elected, and he has certain stances on certain issues. And each president is going to have a different set of issues or areas they want to direct their attention towards. So what you want to do is look at the particular person in office and say, okay, are they Republican? Are they Democratic? And what is it they want to be changing? And where will they likely be directing government spending towards? So first of all, we know that Trump believes that climate change is a myth. So maybe renewable energy stocks would not be a good thing to invest in right now because of the fact that the political party in office does not believe in renewable energy. So do you think they're going to be getting a lot of grants or money being put towards research of renewable energies and technologies? Probably not. So that's what you want to look for, is what this party believes in, what their stance is, and what to look for and what to avoid. Now, number 2, we also know that Trump has significantly increased the defense spending budget. So you might say, I'm going to look into companies like Boeing or Lockheed Martin because these companies benefit largely from an increase in government defense spending. Number 3, we know that Trump wants to abolish Obamacare, so maybe private health insurance companies like United Health are looking like an appealing option right now. Now, United Health is not what I would call a growth stock. They're a large cap. They're more of a dividend stock or a blue chip stock, but these are just things you want to look for, is the larger trends that are happening around you. And like I said here, a lot of it is political based and party based. And then number 4, we know that Trump wants to take care of our aging infrastructure. So maybe some material stocks like Vulcan Materials or a stock like Caterpillar would be a good choice, because these are companies that will benefit from an increase in the infrastructure budget and updating our aging infrastructure in this country. And I know a lot of people who are watching this are not from the United States, but you can do the same thing wherever you live. Just look at whoever has been voted into office and what is their stance on things. What are they likely going to be directing spending towards? Now, number 2, we look at the economic environment and we ask ourselves, are we in a good economy or a bad economy? And based on that, we can decide whether or not we want to be in a cyclical industry or a defensive industry. Now, cyclical industries are heavily affected by the underlying economy because these are typically discretionary expense items. These are things like your iPhone or things like restaurant spending or travel. You don't have to spend money on these things, but when we're in a good or prosperous economy and people have extra money, you're going to see a lot of money being directed towards these businesses. But then again, when we see a poor economy, when we see a bad economy, and people don't have extra money, they're not going to be spending money on travel or iPhones or restaurant spending. So in a bear market or in a bad economy, these stocks are going to typically do very poorly. So what you can do is take a step back and say, okay, what is it looking like is going on in the economy? Are we likely going to see a bull market continuing, or is there threat of a bear market coming in? And as a result, you can decide whether or not you want to invest in cyclical industries or defensive industries, and you can potentially find growth opportunities in both. And these defensive industries, typically these are like our consumer staples or things we're buying no matter what. These are non-discretionary expense items, and you're typically going to see the same amount of money being directed towards these industries in both a good economy and a bad economy. So that's the economic side of it. It's the whole picture of what is the economy doing. Do people have more money in their pockets, or do they have less money in their pockets? And what is likely going to happen in the future? Is it going to stay this way for a while, or do you think we're due for a market correction and for an overall bear market and poor economic times? That's what you kind of want to consider. And then third of all, we look at the social side of things. And this is my favorite way to look for potential growth investments, is looking at the social environment or the spending habits. And I always look at the young people. I say, what are the young people doing with their money? What are people doing with their money? And then finding potential opportunities based on that. So first of all, we know that millennials in particular spend a lot of money on dining. In fact, a lot of young people spend more money on dining than they spend in the grocery store. And so maybe some restaurant stocks are looking like a good pick at that point in time, knowing that. Number 2, we know that people are spending more money on travel. Maybe you're looking at a stock like Booking.com. They do all the hotel booking websites. And third of all, we know that this stay-at-home culture is very popular now, of staying at home and having everything brought right to your door. So maybe you're going to look at a stock like Amazon or Grubhub as a result of that. But basically what you're looking to do here is look at the political, economic, and social environments and determine what is going to be going on within each one of these and what companies will benefit and what companies might not do so well as a result of this. And then you're going to look for potential growth opportunities. Now, later on, we're going to talk about how you kind of do this by going broad and then narrowing down. So it's easier to find a breakout industry and then find a good growth investment than it is to just cherry pick an investment out of nowhere. So maybe you don't know exactly what restaurant or travel stock you wanted to buy, for example, but if you did believe that the travel industry or the dining industry was going to continue to do well, restaurants and dining, then you might decide you want to invest in a company that is within that industry or sector, but you don't know exactly which one that is yet. We're going to talk about that more later on. And in this video, we're going to be talking about megatrends, or another opportunity to find potential growth investments. Now, I just want to warn you guys, this is where you can get into the territory of the 100 plus PE ratio, or the sky high forward PE, or the astronomical PEG ratio, because these are usually the very exciting industries that a lot of people are investing in. People get really excited about the potential growth opportunities, and then, like we've said before, all of that anticipated growth gets priced into today's number. But one of the ways you can find potential growth investments is by looking for mega trends. And these go beyond the social, economic, and political environment, because these are moments that make you say, this changes everything. From here going forward, everything changes. In the past, this was things like going from fat screen TVs to flat screen TVs, or the invention of the microwave. Things like this where it changes our lives forever. That is another thing you can look for as a growth investor, is look for megatrends or these moments that make you say this changes everything. But again, keep in mind, these are industries where people get very excited about these future technologies, and they can become very overpriced and overvalued, but there are potential opportunities here if you're looking for growth investments. And I want to give you guys 7 examples of megatrends that I see right now, and there may be other ones that you see as well, and you can find potential opportunities within these. But again, keep in mind, these are things where we're not there today. These are typically 5-10 years down the road, so this might be a longer term growth investment if you're going to invest in a company that will benefit from one of these megatrends. But first of all, let's talk about datafication, the fact that there is massive amounts of data being collected now. And what are 2 companies that would benefit largely from this? It's Facebook and Google, 2 of the biggest data companies out there. So if you believe that data is going to become the world's most valuable resource and there's going to be more and more data collected, then you might want to bet on 2 data companies and look at companies like Facebook and Google. Number 2, let's say you believe in IoT or Internet of Things, where you're going to have devices being connected to the internet, and you think that everything out there is going to be connected to each other and be able to communicate with each other. You might decide to invest in companies like Cisco or Texas Instruments, companies that will benefit from this growth in IoT. Number 3, let's say you believe in artificial intelligence. You think that is the next big growth industry, and you want to get behind a company that's involved in AI, and you like NVIDIA as a result. Number 4, let's talk about autonomous driving. A lot of people believe in that. They think that's going to be the future, and that maybe 5, 10, 15 years from now, nobody's going to be driving and it's going to be the cars driving themselves. That's probably going to happen. It's just a matter of when. And so a lot of people have gotten behind Tesla because they're the biggest company out there involved in autonomous driving. But like we've said here, that future is largely uncertain, and it's not going to happen overnight. This is a big problem that they're trying to solve, and there's going to be snags and bumps in the road. And so that's kind of what happens, is people believe in a breakout industry or a new industry like autonomous driving. They get really excited, they buy shares of a company like Tesla, and then when things are not going perfectly and that stock is priced for perfection, you start to see that stock price fall or that share price fall. But if you believe in autonomous driving, you might decide to invest in a company like Tesla. Number 5, another one is the fact that people are living longer than ever before, and we're seeing a growing population of senior citizens. So they're going to need transportation, they're going to need living facilities, and so maybe you look at a company like Ensign Group. I think this is a REIT, correct me if I'm wrong, we can look into that in the group there, but this is a company that I believe owns senior living facilities, and so if you think there's going to be growth there as a result of there being more senior citizens, that seems like a logical conclusion to me. If we're going to have more senior citizens, they're going to need somewhere to live, and so investing in a company that builds or owns senior care facilities might not be a bad idea. Let's say you are believing in 3D printing being the future and you invest in a company like Autodesk. Or number 7, a bigger one, is the globalization, the fact that companies are operating on a global level and no longer are there big barriers between countries. Everyone's operating together, and so you might decide that you want to invest in international markets to be a more global investor instead of being somebody who invests only in companies that you live in and having that hometown bias of being an investor in only US companies. So this right here is another thing you can do to unearth potential growth opportunities, is pick up on these mega trends, or where we're going to see massive amounts of growth, or these brand new industries. And there are a lot more than this. This was just a few that I could think of off the top of my head, but there are a lot of good opportunities that lie within. But again, keep in mind, this is where you're going to find oftentimes stocks and companies getting overpriced and overhyped, just due to the fact that this is some very exciting stuff when we're talking about artificial intelligence and IoT and autonomous driving. So just be careful and keep in mind the idea of being a value-oriented growth investor, and that should keep you out of trouble. In this video here, I'm going to be showing you one of my favorite tools when it comes to identifying a breakout industry. and that is the Fidelity Sectors and Industries Overview tool. Now, you don't need to have a Fidelity account to my knowledge to use this. I don't have a Fidelity account, but all I do to access this is I go right here to Google, I type in Fidelity Sectors and Industries, and for me it's the top result here, the Sectors and Industries Overview. And what this does is it breaks down an overview of the performance of these sectors, and then if you want more information about these sectors to see the industries, you can hit the plus sign and it will give you all of those. I'm going to go ahead and zoom in here though. I think this is a little bit hard to see, so just bear with me quick. That should be a lot better now. But so anyway, I know I've talked about this in the past, sectors versus industries, but a sector is a broader term and an industry is a more specific term as far as business segments. And so, for example, let's use consumer discretionary. That would be a sector. And so first of all, we can get the performance of the sector. This is the percentage change for today. This is the market cap or the value of this sector. And the 1 year percentage change is what I'm really focused on. And so let's say we were interested in consumer discretionary and we wanted to look at the industries within this sector. It says there are 12 industries, and if we hit the plus sign, it'll tell us what those are. So I'm not going to read all of these here, but it's got auto components, it's got hotel, restaurants, and leisure, media, textiles, apparel, and luxury goods. So what you can do is, first of all, if you're looking at this here and you're trying to work from top down, you're looking to find a sector that's in favor, and then look at that and find a hot industry within that sector. Now again, this comes down to what are you looking for? Are you looking for the red hot industries, or are you looking for an industry with good growth potential that's not necessarily on everyone's radar? It really comes down to that. But if we look at the numbers here, obviously information technology is red hot. They're up 26.29%. Let's see here. Other than that, we're seeing growth with industrials, we're seeing growth with financials, and consumer discretionary. Now, for this example, we are going to be using information technology. So let's go ahead and look at what industries are within the information technology sector. And as you can see, we have communications equipment, electronic equipment, instruments and components, IT services, internet software and services, semiconductors and semiconductor equipment, software, and then technology, hardware, storage, and peripherals. So I don't want to be going after the red hot industry here. This is a very hot sector, the information technology sector, but the top ones in here are software and semiconductors. And so I actually decided on IT services for this example here. So we're going to go ahead and say that we've looked at these different sectors and we want to go ahead and find an investment within the IT services industry. So what we do is we click on this, and this is going to give us more information about this particular industry. So what we're looking to do here is scroll down and take a look at this graph here. This line chart shows us the performance of this particular industry versus the S&P 500. And it looks like this industry began to break out back around 2017. But it's kind of hard to tell, so let's go ahead and look at a longer span of time. We'll maybe even go 5 years. So looking at the last 5 years, you can tell here that the S&P 500 was actually outperforming this industry for a long period of time. And then somewhere around 2017, October of 2017, this industry began to break out above the S&P 500. Now, what I like about this is you can get so much information here. So first of all, over the last 5 years, we know that IT services has returned 78.4%. Meanwhile, the S&P 500 has returned 68.5%. So it's outperformed over the last 5 years. Over the last 3 years, it has also outperformed. We have a 50.1% versus a 28.32% return from the S&P 500. And here it's a little easier to see when this began to break out above the S&P 500, looking at the 3-year chart. And probably even easier looking at the 1-year chart. It happened actually, it looks like somewhere around July, this industry began to break out. And over the last year, like we said here, 26.1% return versus a 11.9% return from the S&P 500. So what we can gather here is that this industry seems like a newer trend here, this trend with IT services. Hopefully it still has some momentum. And if this was something that interested you, you might decide, okay, I want to find a potential investment within the IT services industry. Now, beyond that, if we scroll down here, we get some very useful industry fundamentals. Starting off here, the price to earnings ratio. And last year's GAAP actual is just going to be like similar to your 12 trailing months. And then the PE for this year's estimate is incorporating some of the forward data as well. And then the enterprise value, I believe that's just the average value of the companies within this industry. Earnings per share, the dollar amount, average earnings per share of these companies, the earnings per share growth on the 12 trailing months versus the 12 prior trailing months. Same thing with revenue growth, and then you have the return on equity percentage on average, return on investment average, debt to equity, and then the average dividend yield. And so we're going to be using this data in a little bit, but now what I want to show you is, let's say you decide you want to invest in a company in the IT services industry. How do you find investments? Well, if you click on this here, this is where it begins to prompt you to log into Fidelity. And I don't have a Fidelity account, so I've never used this tool. If you do have a Fidelity account, let us know in the Facebook group if this is a tool you have used. But pretty much what I do is look up IT services companies. And so that's what I did here, and I've stumbled upon this article here from CIO.com. I'm not sure what this site is, but it outlined the top 10 IT service providers of the year, and this is from Everest Group 2018. They must be some kind of analysis group. And so I took these 10 companies and I started a spreadsheet down here, and maybe you guys want to use Excel, maybe you want to use Google Docs, whatever your preference is. But I jotted down these companies, and a number of them were non-US companies, and so I wasn't able to gather much data. Specifically, market cap is difficult to compare because you're going to have to convert the currencies. But what I did is I went ahead and wrote down these companies. I grabbed the 1-year return from this stock, the PE ratio, the forward PE ratio, and then the price to earnings to growth ratio, the market capitalization. And based on that information, I determined what type of investment this was. So first of all, we have Accenture here. They've had a 26.4% return. We had Tata Consultancy Services, a 21.1% return. Cognizant had a 37.9% return. Wipro had a 4.2% return. Now, IBM might be an interesting one here as well. This is one of those Dow Jones Industrial Average stocks, more of a value investment here. They're down 12.5% over the last year. HCL Technologies up 12.8, Infosys up 15.5, and DXC Technologies was the top performer on this list at a 44.8%, and NTT Data at 6.3%. Now, I just went and looked at one resource here, and because this was the top performers, these are probably the largest IT services companies, and if you were looking for a small cap growth opportunity, you would want to do some more research and find some smaller companies that might not be making the top of the list. But basically what I did here is, looking at that industry fundamentals page, I grabbed the industry average PE ratio and then the 1-year return. And one of my cardinal rules here I look for is I want to invest in a stock for a growth investment of a stock that has outperformed the industry. And the 3 stocks on this list that have done that are Accenture, Cognizant, and DXC Technologies. And so those were the ones I focused on going forward. So first of all, Accenture had a PE of 26.8. That's lower than the industry average. A forward PE of 20.7 and a PEG ratio of 2.1. They had a market capitalization of $96.3 billion, making this a large cap growth investment. Now, Cognizant had a 37.9% return. They have a much higher PE ratio now, but their forward PE ratio is a 15.8 with a PEG of 1.3. So what that tells me is that this company is going to be experiencing a lot more growth going forward, or they at least have a lot more anticipated growth, because a lot of that growth is priced in today with a higher PE than the industry average at 32.1, but a forward PE of 15.8 and a PEG of 1.3 is very reasonable. Now, this company had a market cap of $47 billion, making them a mid to large cap growth investment. And then I also included IBM on the list here. They have a PE of 25.2, but a forward PE of 10.9, the lowest one on the list here, but a PEG of 3.8. That's not very appealing, but the forward PE is quite low. If I was going to be considering investing in IBM, I would do some more research and try to figure out, looking at the numbers, whether or not this company is going to be experiencing growth, or what exactly is going on and why that PEG ratio is so inflated. But because they have a market cap of $138 billion, and they're on the Dow Jones Industrial Average, and they pay a dividend, I didn't include that on this list, but that's something you might want to include as well. This is a large cap income and growth investment, so this would be more of a blended strategy. And then finally, we have DXC Technologies, the top performer, with a PE of 24.6 and a very low forward PE of 11.3 and a PEG of 0.29. This might be a very attractive investment if you're looking at IT services. And with a market cap of $29.2 billion, they're a mid to large cap growth investment. So we're actually going to be using Accenture as our example here for further analysis. But if I was doing this and I was actually investing in an IT services company, I would do this research on all of the ones that I highlighted here. I would also do it on Cognizant and DXC Technologies. So first of all, let's take a look at the earnings per share, and the industry average earnings per share over the 12 trailing months was $3.34. And on the left, I highlighted this for Accenture, and it was $5.64. So the earnings per share are significantly higher than the industry average. Now let's look at the earnings per share growth, and for the industry average, it was 15.78%. And down below that, you can see that for Accenture, it is 11.9%. So the quarterly earnings growth was actually a little bit less than the industry average. And then let's look at the revenue growth. And the revenue growth average was 16.16% for the industry. And for Accenture, that was 11.8%. Now, one thing I will say here is that the industry average statistic is using the 12 trailing months versus the prior 12 trailing months. And looking at Yahoo Finance, this is just quarter over quarter from this most recent quarter to that quarter 1 year ago. And so if you did want to get a more realistic figure here, you could very easily calculate this by looking at the quarterly earnings per share data and revenue data for Accenture, and then calculating both the earnings per share and revenue growth from the 12 trailing months versus the prior 12 trailing months, and that might give you a more realistic figure, because I'm not sure if this is an industry that is cyclical in nature, but if so, that means there may be quarters that are better or worse than others, and so you might have some quarters that are seeing less growth. And so if you wanted to see a more realistic figure, you might want to sit down and calculate that yourself, just by getting the quarterly earnings per share and revenue data and figuring out what the growth is over the last 4 quarters versus the 4 quarters prior to that. Now, the industry average return on equity was 29.55%, and Accenture had a much higher return on equity at 41.99%, which is definitely a plus. And then the final thing I'm going to look at is the dividend yield. The industry average dividend yield is a 1.42%, and for Accenture, that is a 1.64%. And then the final thing I want to look at is the dividend yield. So the average dividend for this industry is a 1.42%, and Accenture pays a dividend of 1.76%, so they actually have a higher dividend than the industry average. But that is pretty much the process here of identifying a breakout sector, deciding on an industry, finding potential investments, and doing some very basic fundamental analysis. Now, would I at this point invest in Accenture? I would not. I would do a lot more research. I would then look at things like the dividend history. I would look at more of the fundamentals. I would look at the balance sheet, do some analysis of the financial documents, and read the annual report and go into more analysis like that. But this is basically where I will narrow down my search and decide what companies I want to actually focus my research on. And in this video, I'm going to be teaching you my cardinal rule when it comes to growth investing, and also just outlining the sequence of events of the logical steps you would take if you were looking to invest in a growth stock or a growth investment. Now, this rule is very simple, and it goes like this. You invest in a strong company in a growing industry. Now, yes, like I've said, it's also important to be a value-oriented growth investor and avoid getting into industries that are overhyped, but this is pretty much the cardinal rule, and if you follow this, it should keep you out of a lot of trouble when it comes to investing. But what this comes down to is make sure you're investing in an industry that has growth potential and invest in a strong company. And I want to explain that. I'll explain it a little bit more when we go through this list here. And then this is just the steps you would take if you were investing in a growth investment. So first of all, you got to find a growing industry. And we just went over the Fidelity Sectors and Industries tool. I like using that one. You might have other options out there that you like yourself. We talked about political, social, and economic environment. You can use those to determine a breakout industry or identify one. Or third of all, you might be looking for a mega trend, a moment that makes you say this changes everything, and you're looking to capitalize on that. So once you've determined a breakout industry, the second thing you want to do is find out what companies are within that industry. And this can be easier said than done. Oftentimes what I'll do is I'll find an index that tracks that industry. Maybe it's food and beverage, maybe it's dining, hotels and restaurants, whatever it is. I'll find an actual index that tracks that industry, and then I will find out what companies are involved in that index. And that's oftentimes a good way to determine what companies are involved in that industry. So once you've done that, I say you identify the leaders of that industry. First of all, look for the blue chip giants, the large well-established, financially stable companies. Now, are you going to invest in that blue chip stock? It depends. Are you looking for a mega cap growth stock or a small cap growth stock? It really comes down to that. But my rule of thumb is to be a strong link investor. And what I mean by that is I think it's better to invest in the industry leaders and not the industry followers, because when you see a trend taking place, you're going to have certain companies leading that trend, and you're going to have other companies riding the coattails of that trend that are just hanging on for the ride. And so, in my opinion, it's going to be better to invest in a strong link company and not a weak link company. And this, again, comes down to this idea of, do you want to be the strongest link of that chain or the weakest link of that chain? What would you want to invest in? And I would always say it's better to be a strong link investor. Now, once you do that and you identify the leaders, that's when you're going to analyze the fundamentals and ask yourself, is this a valuation I am comfortable with? Look at the things like the PE ratio, the forward PE, the PEG, the growth potential. Look at the growth of the earnings and revenue and all of that, and ask yourself, am I comfortable with getting behind this company at the current valuation? If the answer is yes, you can move forward. If the answer is no, you're just going to put that stock on your watch list and wait for the right time to buy. Number 5, you're going to plan your investment. You're going to say, okay, I'm going to buy shares at this price. I'm looking to hold this stock for 6 months or 1 year or 2 years. Have an idea in mind of how long you're looking to hold on to this stock. Number 6, you're going to find an optimal entry point, and you may decide to do this or you may not. But if you want to learn more about this, we have Technical Stock Analysis 101 right here in the Stock Radar group. Nicholas J. Paris, a close friend of mine, put together a whole course on technical analysis, and you can use technical analysis to identify optimal entry points for a position, looking at the candlestick charts and looking at support and resistance areas. So if you really want to go all the way with this, you may decide to use technical analysis, look at the candlestick charts, and identify the optimal entry point. And then number 7, finally, you're just at some point going to execute that order. You're going to enter that position. And at that point, you sit back and you relax because you did all of the work beforehand. And hopefully, you made a good investment. Hopefully, you didn't get in over your head by investing in an overhyped industry. But at that point, all of that has been done previously, and you shouldn't really worry after that about your investment. You did your research, you did your due diligence, and if you're following all of these cardinal rules like investing in companies and businesses you understand and not buying into the overhyped industries, you should really have nothing to worry about at this point in time. But anyways, guys, that is it for this video. That is my number 1 rule there, investing in a strong company in a growing industry. And this would be the logical sequence of events if you were looking to invest in a growth investment. But that's all I'm looking to do in this video is wrap up with the key ideas we covered in this course and the main takeaways you guys should have from this. So number 1, first of all, avoid the red hot stocks and industries. This is oftentimes where you're going to find companies trading at a sky-high PE ratio. And so if you're looking to be a conservative growth investor and not an aggressive growth investor, you're going to want to stay away from the red-hot industries and red-hot stocks. Again, that just comes down to avoiding the herd mentality. If everyone's moving into a particular asset, that is typically when I say, all right, I'm going to take a step back from that. I'm not going to be investing in that just yet. Number 2, I would keep in mind having that value-oriented approach of being a value-oriented growth investor where you take some of the principles of fundamental stock analysis and apply those to your growth investing strategy and invest in growth stocks that are fairly valued or even undervalued. Number 3, I would say beware of stocks that are priced for perfection. Again, this happens when people get a little bit too excited about a particular stock or a particular industry, and then as a result, all of that future growth that company is expecting to have gets priced into today's number. And then if that company operates and they have a setback, you're going to see a major correction taking place with that stock because that stock is priced for perfection, and rarely do we ever see companies executing with perfection for a long span of time. Number 4, follow the cardinal rule of investing in a strong company in a growing industry. Like we said, do you want to be investing in the strong link companies or the weak link companies? And I would always say invest in the strong link companies, those that are leading the trend and not following the trend. Number 5 is to include both small cap and large cap growth stocks. We saw that looking at the historical performance, that sometimes small cap outperforms, sometimes large or mega cap stocks outperform. And so it's best to have a blend of both of these. Number 6, we said that the blended strategy is also good in terms of having both growth investments and value investments if you're looking to be investing in some income stocks, some blue chip stocks, as well as some growth stocks, because like we said, at some point in time, you may see the Dow Jones Industrial Average outperforming growth stocks, or you may see growth stocks outperforming the Dow Jones Industrial Average. And so, like we said, you have people argue about what strategy is best, and what works best for most people is to do a little bit of everything and be well diversified. Number 7 is pay attention to trends. We talked about a number of different trends out there. We talked about the social, economic, and government trends that you can find. We talked about mega trends and all these different trends you can find, and then look for potential growth opportunities within them. And then finally, when in doubt about investing, just wait for a sale. If you're interested in a stock that's in a red hot industry or they're a red hot stock right now, wait for the stock to go on sale. It might take a while, but I guarantee you it's going to happen. Don't be investing in stocks that are at all-time highs. You're going to want to invest when the stock has gone into a correction or a bit of a sell-off. You don't want to be investing in a stock when it's flying into uncharted territories. That's just common sense at the end of the day of not buying high and selling higher. The idea is to buy low and sell high. And people who buy high are often buying when the trend is losing momentum, and they end up being the biggest losers at that point when that stock falls and goes into a correction. So when in doubt, wait for a sale.